Wall Street analysts are honestly terrible. I mean, they got a stupid job in the first place, right? Trying to predict the stock market, that's not possible. But even with an impossible job, they're still really bad at it, except for one guy. I mean, you could call him an analyst, you could call him what you want, but he's the one guy who can predict the stock market. I'm talking about this guy right here. Oh yeah, I even tweeted, gonna tell my kids this was the greatest market wizard. Say what you will, but the guy only sees one direction for the stock market, up. You guys remember this tweet, right? Stock market at all-time highs. How are your 401ks doing? 70, 80, 90% up? Only 50% up? What are you doing wrong? Which basically translates to, wow, you suck at trading. But it's nice because he could put his boot on the throat of the Federal Reserve and just keep pumping up markets. And I'm only half joking here because, as we'll see in this video, Trump is actually more correct than a lot of these analysts most of the time. But before we get into the video, if you're trading or investing in stocks, then definitely check out our free explosive stocks checklist. Gives you all the criteria that we use when we're looking for our investments at Fallible and Macro Ops. Free checklist, there's a link down below in the description and comments. Definitely go check it out. Super helpful. So today we're gonna go over Bill Miller's quarterly letter, his most recent one. And Bill Miller is a big hedge fund manager who did really well back in the day, had a pretty rough period, and now he's back to the top again. And here's a tip, letters like this and letters from any of these fund managers, they usually have a lot of great insights because these guys are pretty much teaching their clients, so the rest of us can learn a bunch too. And this letter is all about how stupid analysts are. Well, he didn't say that, but I'm saying that. So basically he starts off talking about how the methods that these forecasters use for Wall Street are just garbage. He says, like, Paul Samuelson, one of the 20th century's greatest economists, was once asked how far into the future a good economist could forecast. He quipped 1 quarter back. And what he means by that is that all of our predictions and forecasts that you get, not only for Wall Street, but anywhere, it's all usually based off very recent events that just happened. Which, if you think about it, doesn't make much sense, right? Just because something already happened, especially if it just happened, doesn't mean it's going to happen again in the future. Or it doesn't increase the probability of it happening. That's called recency bias. But recency bias is pretty much what infects all of these Wall Street analysts. So he said a year ago, following the worst December for stocks since 1931, and you remember we had the opposite of a Santa Claus rally in 2018. It was rough. But because of that, the outlook of all these analysts was decidedly cautious. And the great worry was that the global economy might be on the brink of recession, due in part to the Federal Reserve's raising of interest rates. Few, if any, predicted what actually happened, which was a super strong year. 2019 was great for returns. And the reason they didn't predict that is because how bad the fourth quarter returns were. It's that recency bias. If things are bad, they think it's going to continue that way. Now, last year, just a month ago, we saw how strong the stock market was. Basically the opposite of 2018, where we closed at record highs and the market couldn't be stopped. But still, the so-called chattering classes, which are the guys who, are just talking about the stock market, like these analysts, they don't actually own anything or run a fund or anything like that. They didn't have much enthusiasm. That's another thing you got to realize about all these Wall Street analysts. They don't actually have their money where their mouth is. No skin in the game, so they could predict whatever. That's why you see some analysts make this huge prediction every year, the same prediction, because they're hoping just one year they're going to be right. Because if they're wrong, there's really no penalty. But if they're right, then everyone would be like, oh, that guy called the crash. Now, if they actually had money in the market, if they were wrong and doing the wrong thing with their money, well, then they're going to go out of business. They're going to lose their money and their clients' money. They won't survive. That's why it's much easier for analysts. So even though the stock market was so strong, everyone said they were cautiously optimistic. And the reason why they do that is because they always sound more serious or smart if they're cautious and express concerns about the risks that are always lurking about, especially when stocks are at an all-time high. As an analyst, you would lose your job if you were just a stock market cheerleader. That's why analysts, they seem to skew bearish. They're like, yeah, things are good, but we're waiting for the other shoe to drop. Which is why I was saying Trump, with his constant cheerleading no matter what, has actually proven to be more right than these guys. So when Trump ordered that drone strike in Iran, stocks fell, oil and gold rose. It all made sense. There was an initial period of fear. Now, when I say initial, I mean it should be short-lived. But of course, all the analysts were cautiously optimistic again. Barron's 2020 outlook from a few weeks ago surveyed market strategists, and the consensus was a more muted 2020, with stocks rising 4%, which is very low, and a 2% dividend yield means 6% total return. That is overly cautious, as Bill Miller says, because if you look at the stats, after an above average return in stocks one year, there's an 80% probability that they're higher the next year. And over the past 30 years, the odds of both years being above average are about 50%. And there's a 30% chance both years will be among the 10 best of that period. So summing that all up, if stocks do well one year, they're likely going to do well the next year. The reason for that, well, there's a lot of different reasons like momentum, investor psychology. But the point here is that stats are stats. But even with those stats available, because numbers don't lie, right? All these analysts are still cautiously optimistic. Barron's cover with the January 6th issue, which was not too long ago, headlined "Safety First." And it highlighted stories on how to protect your gains and where to look for income. All conservative things. And the real issue here with analysts is that there's always an immediate change of tone in response to a single unexpected event. And why is that? Why did that drone strike cause them to change their expectations so much? We did a video on that and we explained what is actually going to happen in the market, which was nothing because the underlying fundamentals didn't change. But every analyst, every time something small happens, they're like, oh, stock market is doomed. And the reason for that, as Bill Miller explains, is that the shock and trauma of the 2008 financial crisis was so scarring that people remain risk and volatility phobic. And they see every negative event as a serious correction or perhaps a recession and bear market. Basically, once the 2008 crisis happened, it completely changed investor sentiment for the long term. People are still suffering today, where they think that anything bad, even if it's small, if it happens, they think that 2008 is going to start again because they're scarred. It's like PTSD, which is understandable when tons of people lost their life savings. It was a horrible period. But what happened then influences their current forecasts way too much. So Bill Miller says as long as that attitude prevails, perceived risk will tend to be magnified and real risk will be less than perceived, which provides opportunity for what Ben Graham calls an enterprising investor. So this is what we talk about in all our market review videos about sentiment and the market climbing that wall of worry. So as long as there are bears, and there's a lot of bears still in the market because of this 2008, like this is the most hated bull market, right? A lot of people don't believe what they're seeing and they're bearish. And that's good for bulls because that means a lot of money is still on the sidelines that can come into the market and push prices higher. But it also means you can't really trust these analysts and their forecasts because they're willing to jump at every little thing. Like right now, the coronavirus, the market is dropping because of that. Sure, that's what an analyst might say, but also this is probably a very natural correction when the market has been running up like it has. Whether it was a coronavirus or something else, it doesn't matter. That doesn't mean the bull market is over. It doesn't mean stocks are going to stop going up. You saw the stats I just showed you. As Bill Miller says, stocks will not move in a straight line higher, even if the bull market continues in 2020, as I believe it will. And this was obviously released before we just had this drop in the market. Setbacks and corrections should be expected, but unless something causes the economy to tip into recession and earnings and cash flows to decline, which I do not expect even if the geopolitical situation gets grimmer, then the path of least resistance for stocks remains as it has been for a decade, higher. See, earnings, cash flows, those are the real things that make up the backbone of the market and where prices are going. All this other stuff, not so much. But again, like Bill Miller said, stocks don't go straight up like this. You're going to get corrections. That's likely what we're seeing now too. So don't trust these analysts and forecasters. They're usually wrong about the stock market. You just got to stick to your own system at the end of the day. Whatever your own strategy is, follow that. And if you're looking to upgrade your strategy for finding the best stocks, then definitely check out our checklist. It's going to teach you the set of criteria that we look for in stocks for the ones that have the potential to 10x from their current price. Check it out. It's free. There's a link down below in the description and comments. Just throw in your email and I'll send it over to you. And make sure you like this video. That helps with the algorithm so that we could keep growing our community. But also, you should make some comments down below. I love comments. I love the notifications on my phone. I always respond to like all of them. It's my main form of social media, you guys. So feed my dopamine addiction, comment down below. And also subscribe if you haven't and hit that notification bell so you get an email notification whenever our new videos come out. They're great videos, the best videos, huge potential. So subscribe and I will see you in the next video. Stay fallible out there. Bye.